Stephen Koukoulas. Kookie, welcome, mate.
Mark Bouris, g'day. Great to be here, and what a time to be discussing the economy.
You betcha, mate. Look, let's talk about the elephant in the room. So, last couple of days, the current federal government, which is the Albanese government, whilst they're having a few dramas at the moment, but nonetheless, they commissioned an inquiry into the handling of the COVID period.
Yep. Which,
of course, was a period when the Liberal Party, the Liberals and the Nationals were in government. So we're talking about, as we know, 2020 to 2022. And one of the findings of that inquiry was that the federal government's stimulants or stimulation of the economy, and leaving aside the RBA, what they did too, but was a large cause of inflation in Australia today, which, by the way, right now, mortgage holders are paying for because, we had to bring in a higher interest rate to control inflation. And, of course, Dr. Jim Chalmers has made that point very clear because he is the current treasurer. What do you think about that?
Yeah. A couple of things. At the time, and people sort of seem to forget how bad conditions were, not just socially. We're all sitting at home and fearing we're getting COVID and all that sort of stuff.
So give me a bit of data. What happened? So like February, let's say March
2020,
yep,
and then beyond, a few months after that, we were fearing that this would be a pandemic that would kill lots of people. We're getting information out of Europe, Italy. There were people dying in the US, other places. There were sort of huge numbers of people dying, catching this disease. It was horrible. And apart from the social and health effects, which are obvious to all of us, governments around the world, including our government here in Australia, were worried about what it would cause for the economy. If we were all sitting at home doing nothing, we lost our jobs, we weren't getting paid, businesses were shutting down, it would be a catastrophe, of course. And there were a lot of initial forecasts, including from the RBA, including from Treasury at the time, that a sort of do-nothing approach would see unemployment hit 15% at least, have a depression, not a recession, a depression rivaling the early 1930s depression. So what was done, and appropriate in my view, was, and this is around the world, including here in Australia, that the Morrison government with Josh Frydenberg as treasurer spent a lot of money. JobKeeper and JobSeeker were the two big ones. There was a construction fund. There were a whole lot of other measures to ease lending restrictions and people going insolvent, those sort of things. There were conditions that were put on those sort of things. So there was everything thrown at the economy, and in my view, that was correct. Because at the time, we were very scared, genuinely scared economically about what would happen. And Australia wasn't the Lone Ranger. It happened everywhere. Now, that COVID inquiry, which fueled inflation, the bottom line is, yes, it did. That was the price we paid for the Americans, the Europeans, us here in Australia, every country under the sun pumping money into the economy. Yeah, we had this discussion a couple of years ago when inflation was going up. Why? Part of it was because we had interest rates at zero. So the Reserve Bank played its part too. But the fiscal policy, the budgetary policy measures, spending, tax breaks, these sorts of things were huge. And so when we look back about, well, why did inflation go from 2% to 8%, which it did by the end of 2022? A lot of it was due to that, yes. So in a sense, it's correct. But would I have done anything different? Probably not, because you throw the kitchen sink at it. And if you spend too much, this is where the debate becomes a little bit more sensitive. You pull the money back out of the economy a little quicker than perhaps they did. And they being the federal government, without being Labor, Liberal or anything like that.
So don't extend it.
Don't extend it. And maybe, just maybe, we should have clawed back some of the JobKeeper payments to companies that didn't really need it. Because some companies did really well because we all bought new TVs and furniture.
Qantas, for example, got a lot of money.
Dare I say, they got billions.
And $2 billion, as a matter of fact. And I think, because someone asked me this question this morning, do I think that some of these companies profited immensely from the JobKeeper payments?
Yes.
The answer is yes.
Yes.
But then why, therefore, did this happen? Well, I recall that it had to happen in a hurry. And, it had to be done through the ATO. It was done through the ATO, if you
Correct.
recall. And the administration of something like this, whilst they could have sat down and sort of, tightened it up really tight, it would have taken them so much time that we would have lost the benefit of actually releasing the money immediately, because we had to release the money immediately. So the game was, let's just get it out there and deal with the problem down the track.
And by the way, Mark, if I can say this, it sort of worked.
Yeah.
Because unemployment peaked at 7.5%, not 15%. Fantastic. That's a couple of million jobs that were saved. A couple of million people had an income that kept them afloat.
And businesses
and small businesses kept afloat during this period,
Correct.
even though they weren't selling much, if anything at all. So that was one thing. We had one horrendous quarter of GDP. I think it was minus 7% in the June quarter 2020. And then we had bits and pieces, and then we've had the economic recovery since then. So yeah, it's one of those things, an analogy I like to use. You've got, the art gallery burning down. You've got, the Mona Lisa's about to burn. It's sort of just in the room next door. What do? Oh, well, we use more water or less water. No, you put out the bloody fire as quickly as you can so you don't destroy everything, rather than saying, oh, maybe we could have used a little bit less water and sort of have a bit more water for the next fire that comes along. No, you throw the kitchen sink at it because it was a problem. The question is, what do you do when the COVID pandemic ends and we have the lockdowns ending? Maybe you withdraw. And this is the interest rate question that Dr. Lowe had on the RBA, but also from a government perspective, you get some of that stimulus, that cash out of the economy to cool that inflation pressure. No government in the world did it. So again, Australians weren't the Lone Rangers doing that. You look at the Americans now, look at their budget, you look at, again, Europeans, the problems they've got. Again, the UK, Canada, they've all got horrendous budget positions. Our budget's actually a little bit better, by the way, but, you could have done a bit more, but that's, Harry hindsight.
And of course, another argument in hindsight as to it would have been better for our government not to have spent as much money or thrown as much money at it, or stop throwing money at it at an earlier date, is that our inflation has endured for quite a while. But that's got nothing to do with the fact that money was thrown at it. That's got something to do with the way the Reserve Banks decided to roll their interest rates out, interest rate increases out. Maybe another thing we could reflect on is, did the Reserve Bank go hard enough, fast enough?
Yes.
And that's
again,
a different
we had
issue.
That discussion, and we go back, and I don't mean to bring up Phil Lowe again when he was governor, but he did make a mistake. He acknowledges that now, that at the end of 2021, when he said, we're going to keep interest rates at 0.1% for 3 years, even though the inflation was starting to pick up around the world, and other central banks, the Kiwis, the Canadians, the
US.
Americans, were hiking interest rates. He said, no, we're different. Had he gone earlier in hiking rates, and maybe a little bit more aggressively in that early part of the rate hiking cycle, when rates started at 0.1. So it was not coming from a very high base. Indeed, it was coming from an incredibly low base. Maybe that would have nipped a little bit of this inflation pressure. I don't think it would have beaten all the inflation pressures that came through, because some of them also, we've got to remember, were outside the control of government spending and interest rates. They were supply chain problems. Remember, you couldn't buy a car for a year because they weren't making them, because everyone who manufactured the cars was sick with COVID in Korea and throughout Europe. We couldn't buy them. There was the supply chain problems. The shipping rates went up because no one was able to man the ships that were carrying these containers around the world. So some of these things that caused inflation to pick up had very little to do, nothing to do, frankly, with interest rates or government spending. So that's one other thing that we've learned. So, why did the price of a lot of imported goods and cars go up? There weren't any available, and people had a bit of cash. I want to buy a new car. Oh, there isn't one, so I'm going to bid up the price. So a car seller puts up his prices, and that came through.
And I have the cash to bid up too, because my business has been given JobKeeper.
Correct, and so there are many like most things in economics. It's rarely one thing causes a good thing or a bad thing to occur. There are many parents to this problem, and some was supply chain, some was interest rates, some of it was government spending. But to blame one cause and one cause only is a bit too simplistic, to be frank.
Yeah, right. And I think they've viewed that because it's important to get some context around that report. The other thing that's come out in the last couple of weeks was and we've talked about this ad nauseum, but we've got to talk about it again, is the unemployment number.
Yes.
The unemployment number Yeah, for me, disappointingly, come at 4.1. 4.1 again? Yeah, so we haven't.
4.1, yeah.
But no movement.
Yep.
It's come 4.2, 4.1. It's sort of hanging around.
It's been 4.4, 4.1, 4.2 for the best part of 6 months now.
Yeah.
Now, and it hasn't gone up in the last 6 months.
Whereas
it went up late last year and then it's just been hovering at 4-ish. Yep.
Yeah. And of all our neighbours around the world in similar sort of situations to us, they're, except for the US, but it's a different situation. Let's just be clear on this. US is different to us. They got a lower unemployment number, but they have much better productivity. Yes. So when you look at our terrible productivity number, I'm talking about productivity per employed person, and our sort of moderate unemployment number, actually by historical numbers, quite a good unemployment number, compared to our other neighbours outside of the USA, but Canada, Europe, UK, and our friends in New Zealand, their unemployment numbers are all got a 6 in front of it. They're 6.
5s and 6s, and even a couple of them in Europe are at a 7.
Yes, so which sort of is.
And we're at 4.1.
We're at 4.1. We're a long way off there. And our RBA governor is looking at that number because what we're here to talk about today is will we get a rate reduction this year? She'd be looking at that number and be saying, well, it's not where I want it to be. What do you think?
Yes, because one of the things that has bugged the RBA this year and why they've kept rates steady when other central banks have been cutting is the poor productivity that you mentioned and the fact that we do have what we might call a tight labour market. That is, the labour market is so strong, the unemployment rate is so low, and 4.1 is historically low, that she fears, and the RBA board fears, that there are some residual inflation wage pressures that are there. Now, the jury's out on that. It's one of those ones in economics. I need to see the next couple of quarters.
I'm not convinced so. We're not convinced.
I'm not convinced either. Yeah. No, in fact, I think we've actually got a lower NAIRU than the RBA's thinking. And the evidence of that's starting to come through because the wages side of that equation, because again, why, and I often get asked the question, why don't we target unemployment at 1%?
Take it to 1%.
Yeah, why don't we try to get unemployment? Because we couldn't afford it. We'd be paying the wages shortage, the skill shortage would be chronic. We can't do it. So it's one of these things that a little bit of unemployment is always going to be there. And it's a question in the current analysis of our economy, whether it's best at 3.5, 4, 4.5, or 5. We're currently, as we said, we're a little bit above 4. And if we did, this is the thing that I think the RBA has misread this, in my view. If we did have an over-tight labour market, there were no workers available, rather than just pockets of shortage.
Like say 3.2 or something like that.
Something like that. If we had it that low, we'd be seeing wages go up aggressively. The last 3 quarters wage number, 1.2, 1.0, 0.8. It's coming down. And the other thing that's coming through on the wages side, SEEK do a really good survey of the wages of jobs that are advertised on their website. And they call it the average asking wage because, I'm putting a job out on there. I'm going to pay $80,000, $100,000, $60,000, whatever. And they look at that and that's turning down already with an unemployment rate with just above 4%. So it's curious to why is the actual wage numbers from the Bureau of Statistics starting to tilt a little lower? Why is the SEEK measure of asking wages from ads on their internet site starting to tilt down? I think it's because of a couple of things. That big inflow of immigration has provided a lot of labour. Sure, there's other issues associated with it, but most of those people want a job and they're happy to work for whatever the going wage is. And I think the slowdown in the economy that is still there might not be showing up in the official unemployment numbers, but it's showing up in demand for labour. And I think that's the critical thing. So we've got this debate that'll probably take a few more months to unfold, is whether we can accommodate an unemployment rate in the low 4s, or whether we have to go to the mid 4s, 4.5, or whether we have to go towards 5%. And the jury's out on that. But the RBA, if they wait too long before trimming rates, might find out to their peril that we get a sharp fall in wages growth when unemployment's approaching 5%. And that's, don't forget, another percentage point on unemployment. It's about another 150,000 people.
Yeah, so it is a bit of an experiment. And we know who calls it the experiment, but like it is a bit of an experiment because, and we do know that the RBA now has to take into account the unemployment in a lot different way to what they've done in the past. So unemployment actually plays a far greater role in the decision around interest rates up or down or leave.
Yes.
And in fact, putting interest rates up would be a bit scary for the RBA if they don't want to see the unemployment number rise too far beyond 4.1. We sort of do know where they think they'd be comfortable with, the so-called NAIRU, the non-accelerating inflation rate of unemployment. It's around 4.5, around that sort of territory. I think it might be slightly higher than that, but 4.6 or something, but it doesn't matter.
That's basically what they're forecasting in their latest statement on monetary policy, 4.5% as the peak.
Yeah, as the peak.
So that implies or tells us that it's 4.5 plus or minus a tenth.
And that tells us that an interest rate still could be on the cards. Remotely possible on the cards is what I mean by that.
Yeah.
But it definitely says to us also probably likely that an interest rate reduction before the end of this calendar year is not on the cards.
I think it's fair to say that, yes, a rate hike is not on their agenda. And in fact, the last meeting that they had, the governor came out when she had her press conference and sort of said, "Did you consider a rate hike at your meeting?" was the question that she was asked. And she said, "No. All we considered was rates on hold."
But she did the meeting before.
The 2 or 3 meetings before, they said, "Yes, we considered a hike. We didn't do it." This one said, "No, we didn't." And we had our board discussion, the board of the RBA, going through scenarios. And that's fair enough. What happens to housing, what happens globally, what's happening to commodity prices, what's happening to unemployment. So they went through this whole smorgasbord of ideas, and that's great. It's fantastic that they're doing that now. But a rate hike's not on the agenda. Now, whether we get a rate cut, it all depends. In a funny way, it's really simple. It depends on what happens to inflation, depends what happens to unemployment. That's it. We can speculate about house prices and speculate about, the Aussie dollar. If it falls, does that mean they're going to import inflation? There's a million things that people can come up with. But at the end of the day, it's really simple. Where's unemployment? If it's trending higher, it goes against a hike and towards a cut. If inflation continues to track lower and lower still and is comfortably within the target, and the RBA is happy that it's within the target, they will sort of say, "Look, we can afford to trim rates." So that's the $64 million question.
But I'd ask you this, Kooky, because it's also about sustainability. So
Indeed.
If we got a freak inflation number, freakishly good, I'm talking about relative to interest rates.
A really nice low one.
Like 1% for argument's sake.
Okay,
Do something stupid.
Yeah.
But let's say unemployment was still at 4.1.
Yep.
Will she look at unemployment at 4.1 and say, "You know what, I don't believe the unemployment number's at the high enough level yet," or in other words, unemployment is not high enough yet in order for me to be convinced that 1% is sustainable?
Yeah.
I mean, what's the interaction? Or could she say, "Wow, that's perfect. We've got inflation at 1%. And
too low.
It is too low. We've done the job. It's 1%.
Yep.
Plus, we got unemployment at a perfect number, 4.1.
Bloody good news at 4.1.
So,
yes, they would trim them. Look, they wouldn't cut them aggressively. They'd probably go 25, wait another meeting, 25, just to see that it's confirmed. So sustainability is the thing you mentioned, Mark, and that is spot on. Anyone can get a 1 quarter down or up on inflation, whatever. You've got to sort of be a little bit careful with that.
Well, we had a two in front of the last monthly.
The last monthly one, the August one, did have a 2 in front of it.
2.7 or something
and
like that.
And that's because some of these subsidies were coming through on electricity and transport fares in Queensland and a few other bits and bobs that were coming through. And petrol was coming down. So some of those sort of things were happening. But the bottom line is that if we got a nice low unemployment rate and inflation was really, really low, they would trim them.
Right.
They wouldn't slash them. I know that's a subtle difference, but we'd be talking about, this is over a 12-month period, 50 to 75 points of cuts only. If unemployment got towards 4.5 or 5%, we'd be talking 100 to 150 points of cuts.
Right.
So there's sort of like a matrix of unemployment, inflation, a little bit of inflation and no unemployment. So there's all this sort of stuff. And so it's really, really important.
What about the politics of all this?
Election in May. Labor would be desperate for a rate cut to sort of say,
we bought it.
We've helped you with your electricity prices. Now we've got inflation down. We want a rate cut. So it's really important. And by the way, Mark, breaking news, just by the way, we're recording this on Inflation Day. So I'm just going to
CPI numbers coming out.
CPI numbers come out. I'm just going to go to the ABS website on my phone and see what they have done for the September quarter. Just bear with me because we've got breaking news coming through. Refresh my page. Oh, my God. Quarterly, 2.8.
Wow. So that's the September quarter.
September quarter rose by 2%. Sorry, 0.2%. Annual, 2.8. I'm just going to go to these trimmed mean measures. So let me scroll down the page.
I'll bet it's been over 3.
Trimmed mean was 0.8.
Yeah. So,
3.5 annual.
Yeah.
And just by the way, I'll have a little look at the monthly figure for September. Bear with me because I love the monthly data because it's right up to date. My God. I'm glad you're sitting down. 2.1.
What?
In the year to September monthly data, 2.1% annual inflation. So that'll start feeding into the December quarter number. So I'm sitting here right now really excited.
Yeah.
Pardon me, who fucking Ray? We've got inflation. I won't say we've got it under control, but this is such an encouraging indicator. As we're having. So 2.1 annual inflation, just looking at where the hell it came. It was in, electricity prices are down 24% through the year. Government subsidies, that's fair enough.
So, but she's already said she's not going to include
things
that.
like transport were minus 3.8. Communications minus 0.8. Where are we?
Any other big reductions?
Well, things like meat and seafood were only 0.9. Dairy minus 0.2. But see, things like cigarettes were up 12%. That's all bloody tax.
But she should trim that out.
Yeah. Housing was 1.6, and that's dwelling rent was still high, 6.6%.
Whoa.
So dwelling rent's still high.
So services is up.
Health was 4.8, so it's a health service thing. Holiday travel 2.5, right on target. So we've got this, 2.1 for the monthly indicator, 2.8 for the headline figure. Of course, the trim mean is high because they exclude things like this electricity subsidy. But if you're the RBA now, I reckon, look, they wouldn't be cracking the champagne, but they'd be saying, that's a really good result. We are happy with that. And yes, there are distortions from government tax policy, but it feeds into inflation expectations because you and me and everybody listening and everybody out there is getting that lower electricity cost. They're paying a bit less for the moment for their petrol. With inflation at 2.1 and wages at 3.5 or 3.75%, I'm certainly not saying the cost of living crisis is over, but it's turning. It's good news that inflation's falling. And just by the way, when we look at some of the consumer sentiment numbers in the last month, they've been a little bit better. So maybe people are realizing, some of that horrible inflation, which was really killing me financially, it's not over, but it's no longer that boa constrictor squeeze on my finances.
So just to give us some context, though, all it means is that the increase in the cost of goods and services for the September quarter from the June quarter and also for the year to the end of September are lower. It doesn't mean that the cost of living is lower.
No. The rate of increase is
that's what's important.
So it's only 2.1% using the monthly figure, 2.8 using the.
So we're not all of a sudden getting life's not cheaper.
No. Life is not cheaper. It's just the rate of increase is to where it should be. And again, we've got to remember that when that 2 to 3% target, plus 2 to 3% target was set 30 odd years ago and confirmed by Peter Costello when he became Treasurer in 1996, I think it was.
And confirmed last year too.
And confirmed again by Michelle Bullock and Jim Chalmers, which is good. Yes, tick. I don't think any side of politics would ever dare tinker with that. So 2.5, it's in the context that on average and in normal circumstances, Australian wages go up by 3.5 to 4. So if you've got just say we take the lower end of that, 3.5% wages growth, inflation at 2.5%.
We're ahead of the game.
We're ahead slowly but steadily. It's a get rich slowly rather than get rich quick sort of approach. And again, we've got a lot of ground to catch up after the falling real wages from that inflation spike over the last couple of years. But it's not just light at the end of the tunnel. It's starting to happen.
So, because if I could go back a year, I can't remember what it was for the September quarter last year, but for the June quarter last year, it was like 6% or something.
It was very high, yes.
Yeah. So, and then it was 3.8% for the June quarter this year.
Correct.
It's now
3.5 for the headline figure.
Yep.
Oh, so 2.8 for the headline figure.
And 3.5 for the trim mean.
Yep.
So, the Reserve Bank must be happy. It's going in the right direction.
Yes.
Do you think this is enough to get her excited about giving us a pre-Christmas reduction?
With that unemployment number at 4.1, probably not. I think, well, they meet next week, Melbourne Cup Day, half an hour before they jump in the races. That's a busy afternoon for many people. But so next Tuesday, 2:30 Eastern Coast time, not counting Queensland, sorry, daylight saving. We're going to get that RBA decision. I think you'll see with this number and just the other economic indicators too. We know the economy is still pretty sluggish. We know the world's cutting interest rates. Most other countries are. She'll say that the board considered the circumstances with which they would be finding it possible to cut interest rates. And she might outline that. She might say that we need another quarter or two of low inflation. We might need to see another 3 or 4 months if the unemployment rate creeps up. We want to see wages growth continue to be well contained. We'll keep an eye on commodity prices, the global. So again, Mark, there's 101 moving parts of this equation, but I think we can, with these numbers that popped up 5 minutes ago, I think it's safe to say rate hikes are dead. If ever they had a sort of hint of life about them, I think we can comfortably say no way. The debate now, I think more generally, will focus on when and how many rate cuts are likely. As I sit here now with a quick instant analysis, I'd say probably the first cut, to be fair, won't be until the February meeting. By then, they'll have another quarterly inflation number to reinforce this good news.
They'll have the December numbers.
Yes, December and December quarter numbers. They'll have another couple of unemployment numbers. And I still think unemployment's going to drift higher because the job ads are still weak and the economy's still relatively weak. And they'll have a bit more information from the world economy. US election, heaven forbid. That goodness knows what to expect there.
Because they have targeted that though. So they are following it closely. They're worried about the inflationary pressure, either party winning.
Yes, and from around the world. So the US, obviously the biggest economy in the world. What happens there is hugely important, and let's see. But we know that commodity prices are down. China, our major export market, still very weak. They're cutting interest rates since we spoke last, Mark. So,
but that's stimulation. So
yes, that stimulates. But bad economy in the meantime. So we're sort of seeing this really, what do we call it? This really mixed picture of things happening. But I think it's fair to say, and the RBA acknowledge this. Interest rates now at 4.35% are restrictive. Yep, they're hurting. And the RBA governor would say they were meant to. We needed to get that inflation rate down, and we're getting there. We want to get another couple of months of confirmation, but we're getting there. We don't need to hike anymore because of the inflation picture, which means that we're probably going to keep them steady, and we could cut if, and this is where she articulates, the next inflation reading's again low, next quarterly one, and the unemployment rate ticks up.
What could blow it up?
Oh, gee.
I mean, blow it up against us.
Against us, and so to say the rate hikes come back onto the agenda.
Or at least no rate reductions. In other words, what could blow the inflation number up?
It's got to be a demand driven. It's not just a temporary jump in the oil price from the Middle East and all the horrible things that are going on there. And it's not just going to be necessarily whoever wins this presidential election. I think both, whether it's Harris or Trump, both of them are going to do something on a trade war with China.
A reduction in taxes.
And higher tariffs and this sort of stuff and taxes. So they've got different policies. Of course they do.
But they're both potentially inflationary though.
Yeah, and in fact, interestingly, Mark, it's a really good point that you raise. In the last 3 or 4 weeks, as Trump has sort of looks more likely to win, not guaranteed, but more likely to win, the bond market's sold off. Bond yields have jumped, and that's a precursor to the effect that they think, well, if he gets in, he's going to impose some big tariffs, which pushes up prices. He's going to give some big tax cuts, which stimulates the economy. And the Fed, even though they're expected to cut interest rates, the US Federal Reserve, same as our RBA, they're expected to cut interest rates. Maybe they won't do too much anymore. And so the bond market's selling off. So we're getting all this incredible movement in the yields based partly, or importantly, on who's going to win this election. So markets will be watching that election outcome very, very closely.
So will she.
Oh, yes, the RBA governor will be too.
Do you think she'll talk about that in her next release?
Probably not, because her next press conference is before we know the results of the election.
I know, but do you think she might flag it because international markets?
I know. Well, she's been asked about the role of government spending in Australia on keeping inflation higher for longer. She let that one go through to the keeper. She doesn't want to get into politics. And I think she explained that by saying, Jim Chalmers has got his job to do in terms of budget and cost of living relief and all this sort of stuff. I've got my job to do with inflation and unemployment. So she's very diplomatic in terms of not answering it. I don't think she'd jump not into the US politics. She'll talk about the world economy. She'll talk about what's happening to the bond market. She'll talk about global inflation pressures, but I don't think she'd say, well, if Trump wins, it's a disaster for us. I don't think she'll say that.
Do you think that Michelle Bullock right now is sitting there as excited as you are and I am?
I think she is. She wouldn't show it because she's a central banker. Central bankers don't jump up and down like you and I.
They play a game of chess.
Good bit of news. But I think secretly or behind closed doors, she'd be saying, this inflation news is very good. And by the way, I'm happy that it's occurring when we've got a 4.1 unemployment rate.
Yeah.
And I think the RBA board and Michelle Bullock in particular are certainly smart enough and wise enough and pragmatic enough to sort of say, maybe we did get this Nehru wrong. Maybe we can have an Australian economy with an unemployment rate between, because every month from 3.5 to 4.5, without there being sustained wages problems being too high. And maybe we can trim rates again. And all we're talking is 50, 100 points, not a massive rate cutting cycle coming up next year, but we can trim rates a little bit to give a bit of relief, to grow the economy. And importantly, this is what I think she might say at her press conference next week, we want to lock in the employment gains. We came through the COVID pandemic when nobody thought we'd get an unemployment rate at 4%. Nobody.
Well, less. We ended up
being 3.5 at one stage, but nobody thought that. But here we are. It's a little bit like, Mark, you and I go back a fair way. It was a bit like when inflation did fall to 2 to 3% in the early 90s. We remember Paul Keating? Yep. We snapped the inflation stick. When the RBA hiked interest rates to 17% back in the late 80s, early 90s, they didn't do it to target inflation. It happened by accident. But when it happened, let's just take it. It's like finding a $50 note on the ground. I'll pick it up and stick it in my pocket. You beauty. If we find that one of the legacies of all the COVID and all these other things that have occurred is that we've got an unemployment rate in Australia that's sustainable, your point, at 4%, plus or minus a little bit. Unemployment rate, at 4%, with inflation averaging about 2.5%. That is an outcome no one would have dreamed about. And as an economist, I would take that, and I'm sure Michelle Bullock would be doing a little bit of a jig in her office.
So are we talking about a Goldilocks scenario?
I'm always reluctant to say that, but it's looking as if we could, with careful management of economic policy, not just from the Reserve Bank, but of course we've got the budget, we've got our own election here by May next year, that with careful policy management, we could just sort of manage the economy a whole lot better than we used to do.
So if we get a couple of rate reductions next year, and if we can keep unemployment at the low fours,
yep.
4.5 is not that high.
4.5 is still pretty good. Yes, correct.
I would be happy with 4.5. I don't want anyone to lose a job. Don't get me wrong, but 4.5, I mean, that's still a bloody good number historically in this country. If we get, particularly given what's going on in other countries, relatively speaking, we would be in a proper reset of our economy. Good inflation, good unemployment. GDP probably needs a bit of a kick along, and that'll come along as a result of interest rate reductions.
Yes.
We could get GDP back up to the high 2s, maybe even a 3.
Yep, high 2s would be a good result. And again, as you mentioned, the Chinese stimulus, as we know, it takes a while for a policy change to impact the economy, but the fact that the Chinese have done so much will help our economy next year.
Yeah. So we potentially in 2025, sometime in 2025, could be in pretty good shape.
I think we could be in pretty good shape. Yes, the economy will recover. Bottom line GDP will pick up a bit. And again, it's the interest rate reductions that we expect to happen. Some of this, and don't forget, even the US cutting interest rates and Europe cutting interest rates, they're going to improve their economies. And while we don't trade a huge amount with the Europeans and the Americans, if they're growing stronger, they demand more from China, so China demands more from us. So a strong world economy is good news for us. And with everybody cutting rates, Yeah, I think we're going to see an upward revision to world GDP next year. So that's a good thing. If we can keep unemployment relatively low, that's a great thing. If we can keep it in the 4s, again, just by the way, do you know that in the last 49 years, we've only had 2 years where the unemployment rate's been below 4.5%.
So in other words, every other year has been above 4.5.
47 of the 49, we've been above 4.5, 5, 6, 7s and 8s. And so this time around, again, let's try to maintain it. Okay, we didn't necessarily target it, but we've got there, and let's make sure that monetary policy, budget policy, dare I say, wages policy, industrial relations, all these things that feed into the labour market, productivity, economic growth, let's try to get them right. This is where I hope I'm optimistic about the election campaign and it doesn't descend into a name-calling,
It will.
I fear it will. But we actually get some good policy ideas on the table that we think about: tax policy, labour market policy, immigration policy, housing policy, all these things that are really important for us to grow the economy in a sustained way.
So just one or two more things before we get to your board.
Yep.
The trim mean, is that going to steal your thunder, our thunder?
It'll take some of the thunder away, yes, because as we acknowledge, and it's obvious, the government subsidies did take a chunk off the headline.
And she said?
Inflation. And she has said, even though it's not actually in the RBA mandate, by the way, it's headline inflation that's their target, just by the way.
I know.
She said, but we focus on trimmed mean.
She's already said that.
She has said that at the last couple of meetings. The trim mean's the one that we want to get down. And it's coming down, but that's still not in the target. As we said, that's still 3.5.
Yeah, so 3.5, if I want to steal our thunder a little bit, it's probably 3.5 is the more relevant number too, because a large percentage of what we're gloating about at the moment is off the back of the rebates.
Off the back of the electricity rebate, some of the rental rebate, and as I said, at the state government level, transport fares and these sort of things. Yeah.
So when Dr. Jim Chalmers, no doubt he'll get up sometime today and say, look what I've done, do you think that she's going to be encouraged next Tuesday to come out and sort of say, well, hang on a minute, hold your horses. I'm not sure how sustainable this is because, unless you're going to continually lock in the rebates for the next 5 years, which they can't afford to do. And by the way, Queensland was a big contributor to this because the
$1,000 rebate,
$1,000 rebate
and 50-cent transport fares.
So I don't know what the Crisafulli is going to do, but I'd imagine he wouldn't be reckless enough to keep that going because that's not maintainable.
Free lunches and things like that.
No, it's not going to happen. Yeah. So do you think that's going to be a big point for her?
She'll try to hose down some of this optimism on the headline number. There's no doubt. And she'll be a bit more measured than perhaps you and I are, but she still must acknowledge that this is a good
right direction, 100%.
And for inflation expectations, in the last 6 months, Sarah Hunter, who's the assistant governor, head of economic research in the RBA, and others have spoken about inflation expectations. They don't want them to rocket ahead. The fact now that we can say, factually, inflation is 2.1% in the year to September. And people perhaps are noticing the electricity bill. Oh, the $75 came off. Oh, isn't that nice?
Well, what's the weight on that? So,
electricity is a weighting of about 3 percentage points.
Wow.
So we spent 3% of our expenditure on electricity. The prices fell 25%. So top of the head, it's about over the year, it's about a 0.7.
That's a big
points
chunk.
Just from that.
It's a big chunk.
It's a big chunk.
So if we add the 0.7 onto the headline rate.
On the headline rate for the annual figure, we get the trim rate, which is from 2.8 to 3.5. So yes, there we go. Voila. We've discovered the magic sauce.
Yeah, and of course the payments, now just correct me if I'm wrong, the payment's made as a once-off, or is it
it's $75 per quarter every
quarterly.
quarter.
So that'll maintain itself right through for the next 3 months.
30 June,
the next 3 quarters.
And there's this debate going on. Will they extend it beyond that period? Because again, when it comes off, you'll get the headline inflation rate jumping 0.7.
Yeah.
Or adding 0.7 points to
So really what it means is then, if I'm just to interpret this without labouring it too much, but she might be looking for a further 0.7 reduction in the headline rate to
get the trimmed,
to account to put us to where we want to be.
Yep.
So that That's a big call, though, mate. That's
it is.
Because that means the headline is going to be 1 point something.
It is, because unless all the items in the CPI basket, things that are still going up that are the problem.
Yeah, for example, rents.
School fees, dwelling rent, insurance premiums. Just those. They're
the three big ones. They're the big three services.
The big three, yep. RBA interest rates don't have a huge impact on those. Yeah. Certainly things like insurance and school fees, whatever.
You have to pay it.
And they hike rates. You're still going to send your kids to a school, or they're not going. Schools aren't going to drop their fees. So in a sense, this is where what measure of inflation should we, the Reserve Bank, be looking at? So the trim means fine as far as it goes. Headline is obvious because it's what we all pay. But is there another measure that just gets rid of some of these, what do we call it, government-inspired charges, and then things that are outside its control? So oil price, petrol came down. That's nothing to do with it.
It's gone back up since. But
gone back up, maybe in this December quarter.
The December has already gone up. Yep. It's going up now as we talk.
Here we are, late October.
Yeah. And substantially gone up too.
Yes, I've noticed that too. So again, it's one of those things that it's set by global conditions, what's happening in the Middle East and all that other stuff. It's our oil price. Not RBA interest rates can go to 100%. Oil will still be doing what it's doing. It's not going to change those sort of things. So there's this question that I think the RBA governor will take a step back on Tuesday afternoon, which is giving a press conference after the Melbourne Cup race. And she'll say, look, we are pleased that headline inflation is coming down. We probably have more work to do on the trimmed mean measure, all these underlying measures. We acknowledge that the electricity and other subsidies have taken a big chunk off the headline figure to make it nice and low. But we want to see all measures, not just headline, but the trimmed as well, converging at 2.5%. We're not quite there yet. We know the economy is slowing down. We're on hold. And we won't rule anything in or out, and we'll just see the data for the next quarter's inflation number, for the next couple of unemployment numbers, and as we said before, what's happening in the global economy, including post-US election.
Let's look at the board, mate.
Let's look at the board. Okay, here's our board. GDP growth we know is weak and not really recovering. We're not quite at easing, but it's verging on easing, so that's important. Inflation we've just discussed ad nauseum. I'm putting that in neutral.
Right.
Not hike. We're not cutting yet.
Yeah.
You'd cut on headline.
I'd like to move a little bit. Can we just move a little bit closer to the easing? But no. Yes,
next quarter, I'll tell you what, Mark. If next quarter we confirm headlines at 2.5-ish and the trim means down to 3.0, let's assume, so it comes off another 0.5%, I'll move that to the easing side.
Okay. Labour
market, I'm putting, again, not quite there because the unemployment rate, as we've discussed all show, is low. But one thing we didn't discuss, job ads, job vacancies, the NAB survey of employment intentions are all tracking down. Demand for labour is weakening. So I still think the unemployment rate's going up, and if it does, we'll move that to easing, but not there yet. Wages growth, same as the labour market. I'm just sort of hate to have one foot either side of the fence, but, again, wages growth is decelerating, as we mentioned on that SEEK measure and even the Bureau of Statistics. International economy, easing. Everyone's cutting interest rates. That's an easy one. Everyone but us. House prices, they're slowing down.
Yeah.
Sydney's about to turn slightly negative, I believe, from the numbers.
Yep.
So I'm putting that in neutral.
Yep. That's the first time, by the way.
Yep. Melbourne's weak. And the smaller cities such as Canberra, Darwin and Hobart, they're actually falling as well.
Yep.
Adelaide, Brisbane and Perth are still very strong, but the rate of increase is slowing down.
Yep.
There's a bit of a cooling in housing. So that's an interesting phenomenon.
Well, a real estate agent, a well-known real estate agent told me today from Sydney that it's now turned to a buyer's market.
Right. There we go. And the auction clearance rate last weekend, I think, was quite
down.
Low.
Yep. 62%.
Very low. Retail sales easing. We consumers are still not spending yet, even though we've got a little bit more upturn in consumer sentiment. It's still low. We're still pessimistic on average.
Yep.
It's come off a very, very low base. So you come from the wooden spoon on consumer sentiment to now be third last.
Yeah.
If we use a footy analogy, we're not yet on the fringe of the 8. I'll move that to neutral when we get there. Building approvals, that perennially weak. That housing debate, I think that's going to be one of the election discussions.
Has to be.
Both sides are talking about it. Hooray, in a way. And you know what? The coalition rollout of infrastructure funding for, roads and guttering and sewerage and water and electricity, great. But then we also need to build more houses and we need to build them in the city as well. So that's what Labor's doing. So in a funny way, I think we've almost got if you could cherry pick what the Libs are saying and cherry pick what Labor's saying, you might actually get a solution to this problem, but we'll see what happens there. Business investments, okay. That's neutral. That's fine. It's not a problem. It's not great. Business confidence, it's starting to turn a little bit weaker. Not catastrophic yet. Commodities, you mentioned oil price, very volatile, just neutral. We don't have a collapse in commodity prices. Iron ore, which did fall, got a boost when the Chinese cut interest rates, so it's back to neutral. Stock market's booming.
Unbelievable.
Now, they're not going to hike, but I'll put that in neutral. And current rates are restrictive, so I'm moving that to the easing side. So you can see here, there's quite a few in the easing cycle. Still a few not quite there.
The three big guys.
This is the stuff that has the higher weighting. We've discussed that in the past. These GDP, inflation, labour market and wages, they're the things that matter most to the RBA.
Because the stuff is currently sitting in the easing column, they all feed into the top guys.
They feed in with a 1 or 2 quarter lag.
Yeah, with a lag.
Yes, correct.
So, fearless predictions. November, Melbourne Cup Day, rate reduction, rate stay, rate increase.
No change. No change.
Okay. And next fearless prediction, of course, we can't see the money markets at the moment because they haven't enough time to work on it. I mean, you can get a number, but it won't be sort of full enough.
I'm just going to have a very quick look, if you don't mind, just see what the bond market's done, if that's okay. Yep. Very little changed. I think the bond market's reacting like we have.
Yeah.
Headline figure, that's great. Trim to mean, a bit high. So we're sitting here with the 3-year bond just under 4% compared with the official cash rate of 4.35.
So which basically says no real movement.
No. So there's a couple of rate cuts over the course of a couple of years.
Yeah.
Broadly speaking.
Nothing. Well, there's one rate cut and a bit of a rate cut.
Yes.
It's just like 0.35.
Yeah.
So, okay, that's interesting. So, fearless predictions, because, we've got 2025 coming up.
Yep.
What do you reckon?
Look, I think that once we get into 2025, we will see the RBA joining the global party, cutting interest rates, because we will have inflation, trim mean headline, however you want to measure it, in the zone. We'll have the unemployment rate a little bit higher, and we'll have confirmation that even though the economy is probably a little bit better than it is now, we'll still not be booming. It won't be that sort of growth momentum. So we'll see a couple of rate cuts, I think, through the
2025.
course of 2025. Not aggressive. And again, don't get excited. We are not going back to interest rates were during the pandemic. We are talking, I think, a minimum of 50, because they can't just go to 125. That won't have any effect. Minimum of 50, probably up to 100 points of rate cuts. So the cash rate goes to 3.35. And if we get a little bit of bad news on the economy or something happens in the US, we might cut a little bit more than that. But that requires a factor out of left field to come and push or force the hand of the RBA lower.
It's interesting, if they start to reduce rates in, say, February, March next year, it's around 7 months later than all the other countries started reducing interest rates, which is equivalent to when we started to put rates up. So we put rates up around 7 months later.
Yeah, May 2022 was the first, and others were hiking in late 21. Yes, correct.
Around 7-8 months.
Yep,
and it's sort of like nearly like patternized and clockwork. It's like we just were a bit slow to put them up, and we're going to be a bit slow to put them down.
I think that might be a fair assessment.
In a very simple way.
No, that's a fair assessment. And the Reserve Bank.
So our economy has behaved appropriately. So because, like in a scientific sense, like in an economics as a science, things tend to behave the same. Like it's just like all scientific experiments. They tend to behave the same unless you're doing something radically different, which we haven't. We haven't done anything radically different.
Correct. We've done what
in the experiment, like our scientific experiment with our economy, which is what everyone does, has been. We've had some small differences, but nothing radical. And it looks like we like everything, like every scientific experiment, but in an economic sense, we're going to be as predictable in our behaviour, the economic behaviour, as everybody else. It seems that way.
It seems that way in the Western world, where consumers are the dominant part of each economy, whether you're looking at the UK, the US, Germany. Yeah, there's slight differences from country to country, but household consumption, household spending is the lion's share of GDP growth.
Yep.
When we face financial pressure, we consumers are not silly. We cut our spending.
Yep.
Happened It's happening everywhere. So that financial pressure was through the cost of living when inflation went up and, oh my God, the price of everything's gone up so much, or interest rate hikes.
Or both.
Or both. And we had both in Australia, well, both everywhere in the world, frankly. And now we respond to it. Some people respond a bit more quickly or a bit more slowly, but we're part of that response too.
And so it's sort of nearly, I mean, I know I don't want to discount the analysis that we do and that everyone else does around the world, but it's nearly like it's just common sense that we will behave predictably like everybody else if most of the inputs are constant, which in our case it is.
And this is probably a topic for another day, but globalization, we are part of the global
makes it much
economy.
more the case.
Yes. So we mentioned the price of oil, but it's also the price of iPhones, the price of TVs, the price of cars that are made
price of Netflix.
Everything. Price of a car made in Korea. If you drive it in London or in the US or in Australia, okay, there's tariffs and a few other bits and bobs that are there, but it's basically the same price. So if the price of a car went up 50%, for example, because the Korean producers put up, everyone would be confronting that.
Yeah.
The price of oil goes up because of a conflict in the Middle East. We all pay that. So the globalization means that while our economies are different, yes, there's different. We've got lots of mining and the UK doesn't have much mining, we've got a different structure, but broadly, very broadly, and from us consumers and consumers in the UK and in the US, we react remarkably similarly to all of these things. And that's why, oh gosh, I wish I had my chart with me. It showed that in the rate hiking cycle, again, the timing was a little bit different and the orders of hikes were a little bit different. But there's this wonderful colours of, I think, 7 or 8 countries. They all went up pretty much together. They all stabilised pretty much together. They're starting to come down a little bit, except us. They're starting to come down a little bit. And so when we see this chart in a year's time, for example, all these yellow line for the US, red line for the UK, purple line for Australia, they'll all be coming down. Now, some will be down at 3, some will be 3.5, some will be 2. There'll be differences. But if you just eyeball the chart, which I love doing, you'll see everyone's confronting lower inflation, weaker growth, inflation hitting people's targets. So whether that's the Fed in the US or Bank of England or the Reserve Bank of Australia, yep, we can trim rates a bit.
Because, what consumers can take away from, by the way, I don't want to take ourselves out of a job, but what consumers can take out of this is, as you just said, pretty much we're all the same. Like most of the countries adopt a 2% inflation number, or somewhere between 2 and 3. We're between 2 and 3, but a lot of them actually dead on 2. We're all pretty much the same.
It's half. We're 2.5. Others are 2. Some use the personal consumption deflator. It's basically 2 to 2.5% Yep.
And whilst the numbers are different per country, and that actually does have some impact in terms of speed at which change can occur, because the momentum can create a bigger speed, a faster speed. Yep. Australia just pretty much follows the behaviour of everybody else. Yep. I'm not trying to take your job away or my job away or our podcast away, but it sort of seems that way. And globalisation has helped that, or globalisation is underpinned. It's underpinned. Totally.
And it continues to do
more
so.
than it's ever done before.
Correct. And as time goes on, it's going to
be
much more close. And even international airfares, they're the same.
There's no arbitrage.
Whether you book a flight from Sydney to London and back to Sydney in London, or you do it here, it's the same price.
You used to be able to arbitrage these things, but you can't now.
The airlines are smart.
Yeah.
Well, they've got around that little trick.
Everybody, where we could sort of play differences, they've worked out the arbitrage. It's a bit like trying to beat the casino. The global economy has worked out all the tricks, and everything's really much more smoothed out.
The only thing that can make it change a lot is if your currency, be it the euro, the yen, the British pound, or the Aussie dollar, does a big gyration for some reason or another.
But it has to be
it has to be a really big move just in the Aussie dollar or just in the British pound.
But that has to be exogenous, because we're all trading with each other, and the things that sort of tend to change the dollar could be interest rates or could be commodity prices in our case. But because it's a global number, it's not moving around too much. And so it seems to me like, the rest of the world's going to be all same. Just timing will be different.
It's just timing and slight orders of magnitude. To put it this way, direction will be that we're all going in the same direction.
Yeah.
It's just a matter of who's a bit faster and who starts a bit earlier, who ends a bit later.
Well,
That's what we're talking about.
Well, Cookie, that's great because we can actually take comfort right now anyway, as you and I sit here, that the world is heading in the right globally, the countries that we can be comparative with are heading in the right direction for us to get an interest rate reduction, and how many is a different matter, but an interest rate reduction at some stage in the near future, 2025.
In the not too distant future. And the interesting thing is that the Reserve Bank will acknowledge that.
Yeah.
They haven't yet. They might next week. And if they don't next week, they will in the December meeting. So we're almost there. And you'll hear a sigh of relief around mortgage holders and small business for that matter who have overdrafts, that it might not be today, but we can see some light at the end of the tunnel in terms of the rate cuts coming through.
Do we have a December meeting?
There's a December meeting, yes.
So we're November's...
there's sort of this funny one. They get one out before the end of the year and then they don't meet again. So there's still no January meeting. And if I remember correctly, I think it's the 6th of February. So there's one about the 9th or 10th of December, if I remember correctly. And then there's another one on the 6th of February.
And finally, do you think the Reserve Bank Governor is going to publish the vote of all the members?
She said she might. I would find that very, very interesting
to
see who's
dovish and who's bullish.
Yeah, and who's got a different view. Because, again, like we're discussing, we know with our
The US does.
Yeah, they do publish it, and so does the UK.
Yep.
And as we have here, okay, we're not RBA members, unfortunately, but, a Warren Hogan or a Christopher Joy or a me or a Shane Oliver or, we have different views on interest rates. We all look at the same data, we look at pretty much and have a different judgment. The 9 members of the RBA board do the same thing. They think, oh, gee, I think, we're overstating the importance of this or understating the importance of that. And that's where the healthy debate comes in. I think a conflict, if everyone is 100% in agreement, it's very boring. If someone challenges you and say, hey, Mark, I reckon we're going to hike rates. Oh, why are you saying that, mate? And you have a debate that hopefully leads to a better outcome.
Well, when they're all sitting around next Tuesday having a cup of tea in Lamingtons and holding hands and singing Kumbaya, I'll guarantee that they will take this segment of our discussion with your board and they'll place it up on their big screen and they'll say, this is what Koukoulas and Bouris have put together, and no doubt they'll be in total agreement with us.
I'm sure they do. I'll have a chat to both Michelle and Andrew Houser, the Deputy Governor, and say, guys, pop this up. You don't need any more than that.
Good on you, mate.
Thanks, Mark.